Cool. So today we want to start the discussion on the topic that is portfolio management. For the starting, like 10 to 15 minutes, we'll focus on why this topic is important for you, why you're studying this topic. And please don't approach this topic from the perspective that, okay, this is one of the topic in CFA curriculum or this is one of the topic in FRM curriculum and that's why I have to study. No, ask the question why? Why CFA Institute or GARP Institute want you to learn this topic? Why any MBA Finance Institute want you to learn the topic? And definitely the rationale for that is it has real application in the finance world. Real application in the finance world. What topic? Portfolio management. So let's put down the heading and have a discussion about why you're studying the topic. Okay? So put down the heading portfolio management. Okay? So portfolio management. Now, why studying this? The reason is if you are a naive or if you are a layman in the finance world, then you will definitely have this assumption that if I take a higher risk, the return would be high. If I take a higher risk, then my expected return in the future would be high. And that's true. I won't deny the fact that it's not true. But this is true in the case of individual investment. What individual investment? In the case of individual investment, when you're investing in a stock, when you're investing in a bond, then this philosophy of higher risk would lead to higher return is correct. It's right. But when you play in a group of stock, what in a group of stock? So assume you have stock A, B, C, D. A, B, C, D. This is a group of stock. When you play with the group of stock, then this philosophy, this assumption does not work that higher risk would lead to higher return. And quite opposite to it, you may find the scenario where the return is high when the risk is low. So it is very important that you understand the concept of portfolio management in and out. And from where this concept stems from. Actually, the name of the concept behind this idea that higher return can come from a lower risk is called as, in the world of portfolio management, as called as diversification benefit. Diversification benefit. You might have heard this phrase that do not put all your eggs in a basket, right? You might have. Now, this is what this statement, this phrase is talking about diversification benefit. Do not take the risk, do not take all the risk of a stock, rather diversify your portfolio, diversify your investment. Okay, but how? But how come? How would you be able to diversify the how would you be able to diversify your portfolio? Pause and think about it. What we are trying to do, we are trying to say maximize the return, maximize the return of my portfolio and at the same time minimize the risk of my portfolio. Okay. I have a group of stock. The group of stock means portfolio. And when I buy the stock or the group of stock in a combination, in a certain combination, try to maximize the return and minimize the risk. Now, those who are already mathematicians here would say the answer to this question is optimization. Mathematical way to optimize the portfolio, right? But even before entering into that mathematical concept of optimization, do you know how would you calculate the return of a portfolio? How would you calculate the expected return of the portfolio? Or do you know how to calculate the expected risk of the portfolio? I know you want to maximize the return. I know you want to minimize the risk, but what is the matrix that will give you the return? What is the matrix that will give you the risk? Do you know that? So the step number one is to find out a way, a matrix which talk about the return of the portfolio, which talk about the risk of the portfolio. Return may be intuitive and you might know how to calculate the return of the portfolio, but how would you be able to calculate the risk of the portfolio? What is the approach? How would you do that? Right? So there are different methods to find out the risk of the portfolio. There is war, and even in war, there are different methods like Monte Carlo war, historical war, or analytical war. But there is another method which is very simple that is called standard deviation. Okay. Standard deviation of what? Standard deviation of individual stock or the standard deviation of the portfolio? How would you find the portfolio standard deviation? And are we talking about the historical return and are we talking about historical risk? Hmm? Are we talking about historical return and are we talking about historical risk? That's also a very difficult question to answer because understand what you're saying. You're saying I want to invest in a portfolio right now today for the future and I don't know would be the return, so I need a matrix to tell me the expected return of the portfolio in the future for my certain combination of the stock, and I want to know what would be my expected risk in the future for the certain combination of the stock. It's not an easy game. Yes, I can give you the matrix, but you need to understand that why you're calculating the matrix, why you're calculating standard deviation, why you're calculating return, and even the calculation of the return and the risk through some mean or standard deviation, even if it is correct. Is it telling me about the future return? Is it telling me about the future risk? Or is it about historical return or historical risk? These are very difficult questions to answer. Okay. So if I rephrase, if I reiterate that why we are studying portfolio management, the answer to the question is very simple. Yes, there is a possibility that you can have a higher return for a lower risk. That's the rationale. But why we are getting into the detail of the portfolio management, why you're getting into the maths of the portfolio management, the answer to the question, because we don't know how to calculate the expected return, how to calculate the expected risk of the portfolio. Even we are not very sure that we would be able to calculate the expected return of the portfolio, expected risk of the portfolio. Okay? Because we are not talking about the historical return. We are not talking about the historical risk because right now, today, I want to invest and earn the profit. And that's why I need to know that matrix. I need to know that maths. And once I calculate the expected return, once I calculate the expected risk, then I need to optimize to get the maximum return of the minimum risk. Again, there is a maths involved. And therefore, there would be a lot of number crunching that would happen. But why we are entering into this number crunching, why we are entering into this maths, that is important. You need to ask these questions, why I'm doing this, why I'm doing this continuously. Otherwise, you will lose the bigger picture. Okay, cool. With that, let's write down the steps that is necessary, the minimum step that is necessary to understand portfolio management. So, step number one, understand how to calculate the return of stock. First, you need to understand if I say return of the stock or expected return of the stock, and specifically when I'm saying return of the stock, I'm interested in expected return. Why I'm using the word expected return? I'm using the word expected return because understand how to calculate expected return because with the help of the expected return, I would know what would be the expected future value, expected future return that would I get. So I need to know what matrix to use. That's step number one. For individual stock, I'm not talking about the portfolio. Step number two. Step number two, understand how to calculate the expected risk of individual stock. And because of the limitation of the syllabus that you have, I may not be able to give you the right answer of the expected risk or expected return. The limitation of the syllabus. But yes, I will definitely talk about that in real world, how to calculate the expected return and how to calculate expected. Yes, that you will definitely find in CFA level 2 or FRM level 2. But in level 1, you don't have the concept of expected return or expected risk in detail in the portfolio management. Okay. They're talking about risk, but not stating whether it is expected risk or historical risk, expected return or historical return. Step three, find the correlation. What correlation between two stocks? Now, this is very important. You need to identify finding the correlation between the two stocks. Why it is important? Because now you're not playing with individual stock, you're playing with a group of stock. So you need to know how the stock will behave with this stock and how this will behave this another stock and how they will behave in the combination. So we'll first start with the correlation between the two stock and then we'll expand that whatever the matrix or formula, whatever we'll get for multiple stock. Now, why we're calculating the correlation of the two stock? Very important line because I would be talking about it in detail. The reason is when you calculate the risk of the portfolio, the correlation is a very important number. It's a very important matrix to tell whether the risk would be high or low, right? How the two stocks are behaving with each other, how they are reacting with each other, what is the correlation between them. It's very important because it will tell you what is the risk of the portfolio, whether the risk is going to be high or the risk is going to be low. And because I talked about the correlation, we enter into the world of portfolio. So I would say then you have to understand how to calculate the expected return of not stock but of portfolio. Ask this question: do you know currently how to calculate the expected return of a portfolio? If I say, okay, this is the portfolio, you have the stock like Tata Steel, Facebook, Apple, and Microsoft, and you have to find out what is the expected return of the portfolio. Would you be able to tell me the expected return of the portfolio? Think about it, pause and think about it, that whether you would be able to. If not, then this session is very interesting for you. Step 5. Understand how to calculate the expected risk of the portfolio. And step 6, which I don't know whether we will be able to cover mathematically in this session, but yes, I would initiate it for you. You got the expected return of the portfolio, you got the expected risk of the portfolio, then what you have to do? You have to maximize the return, expected return in the future, maximize the expected return, and minimize the expected risk. So this is the problem statement which can be solved through the help of optimization. Okay. So these are the steps which are involved in portfolio management. And if you really want to understand the portfolio management in and out, these are the steps, right? Yes, there would be some side discussion about what is the difference between a rational investor or an irrational investor, what is a utility curve, what is the indifference curve, what is my capital allocation line. Yes, that would be the discussion. But the crux of the discussion, it revolves around this. And it makes sense because if I would be the portfolio manager, I would be doing the same, right? Cool. So this was an introductory session on portfolio management. In the next session, we'll start understanding how would you calculate the return and how would you calculate the risk of a individual stock, and then how would you calculate the correlation between the two stock. Okay. Till then, thank you. Have a nice day.